Everyone. Today, our group representing a financial performance between two major Malaysian banks, which are Public and IHB Bank from 2022 to 2024. Public Bank is one of Malaysia's largest financial institutions, which focus on retail banking, SME loans, investment banking, and insurance. It prioritizes strong customer relationship in Malaysia and overseas markets such as Hong Kong, Cambodia, Vietnam, and so on. Well, IHB Bank is one of the top four banking groups in Malaysia, which provide service on retail, corporate, investment, and Islamic banking. It focuses on digital innovation, sustainable finance, and providing financial solutions to individuals and business.
The second key learning we want to discuss is, are the managers generating an adequate operating profit on the organization's assets? For this scenario, we can compare the assessment of operating profitability on assets, measured by operating return on assets, bring a significant performance gap between Public Bank and RHB Bank. Public Bank consistently generates superior OROA, ranging from 1.69% to 1.87% between 2022 and 2024, indicating adequate profit generation from its asset base. This strength stems from a balanced strategy of maintaining healthy operating profit margins, which are between 33.75% to 42.95%, and moderate asset efficiency, which gain an asset turnover of 0.043 times to 0.05 times. In contrast, RHB Bank's OROA is weaker than Public Bank, which are between 1.24% to 1.48% in the 3 years. The root causes is a critical imbalance, while RHB management achieved remarkable high operating profit margins, which exceeding 52%. It suffers from the industry poorest asset turnover, which only have 0.025 times. This indicates that RHB's management is not effectively leveraging its extensive assets to generate operating income. Consequently, despite high per unit profitability, its overall asset productivity is inadequate compared to the more efficient benchmark set by Public Bank.
Now, let us look at the underlying debit structure of this bank. At first glance, RHB and Public Bank appear with similar, both use high leverage with debit ratio at around 90%, which is standard banking model. Their assets are funded primarily by liability, mainly customer deposit. However, the critical difference is not in the amount of debit, but it is in the risk and cost associated with it. For Public Bank, this is highly leveraged structure is suitable and low risk based on the graph given. The reason is it is supported by a very strong ability to cover interest costs, as we can see with healthy TIE ratio. This means debit largely customer deposit are management and post little financial threat. As for Archery Bank, the story is totally different. It is similarly with leverage come with a serious risk flag. The bank weaks interest coverage with a TIV ratio consistently below 1.0 means it struggles to service its debit from operating earning. So while the both of banks are highly leveraged, RHB bank structure is riskier. The cost of its debit is harder to bear, which is introduced vulnerability into financial position. In the short, same two different outcome, public bank will debit efficiently, safely, but if for RHB bank, used to debit carry higher financial risk due to the inadequate earning coverage.
I will analyze the return on equity performance of both banks. Based on the bar chart, the ROE of Public Bank is 19.15% in 2022, 17.27% in 2023, and 17.67% in 2024. Over the past 3 years, the ROE of Public Bank has been stable and exceptionally high. This is a benchmark level performance. The ROE of RHB Bank is also very strong and show a clear upward trend, going from 17.75% in 2023 to 18.28% in 2024. In short, both management teams are highly effective at creating return on capital. Both banks significantly outperform the industry average. However, does a strong financial number automatically translate into a shareholder value creation? Is the market equally optimistic about both banks? To answer that, we must look the second dimension, market variation. Let's see how the market price their earning. On the left, we have the price earning. It shows how much investors are willing to pay one unit of earning. The price earning of public bank is considerably high, between 12.3 to 15. For IHB bank is significantly lower, in the range of 8.5 to 10. Now, look at the right side, the price for public bank is considerably about 1, from 1.46 to 2.03. This means that the market highly valued its price, management, and asset quality, paying a clear premium over its book value. The price book of IHB Bank is considerably below 1, between 0.82 to 0.91. Just we can see that the ROE of IHB Bank is higher than public bank, but from shareholder value, public bank is better than IHB Bank. This is the meaning that a high ROE does not automatically equal to creating shareholder value.
So, looking at the period from 2022 to 2024, it is clear that public bank is the better choice compared to IHB Bank. This is because public bank shows strong financial performance, stable profit, and good risk management. On the left side, it shows that interest coverage is consistently above 1, meaning that it can safely handle its debt. Public bank also uses its asset efficiently and maintains a high and stable ROE, which is reflected in the price-to-book ratio above 1.4. On the right side, it shows that IHB Bank is riskier. Its interest coverage is below 1, its asset use is inefficient, and this results in an unstable market value. So, in conclusion, for investors who are seeking safe and stable returns, public bank is the better option, while IHB Bank is only suitable for high-risk investors.